people's income were protected by government subsidies or government payouts. But supply is actually a bit constrained. I think because of the disruption, we are actually seeing some supply constraint in a lot of areas. Today, there's even supply constraint in semiconductors, right? So we have demand that has maintained, that has continued to grow, but supply that is constrained. What that translates into is basically rising prices. And because of that, there is concern about inflation coming, right? If we look at the latest data from the US, the year-on-year number for inflation is about 4%. And everyone says, oh, that's okay, because compared to last year was the depth of the COVID, so there was a sharp drawdown. And so this 4% is really nothing, it's transitory. But what we have noticed is that the month-on-month number is actually also very high. The month-on-month number is like 0.8%. And if you annualize that month-on-month number, uh, if we're taking it very, very simply, we're talking about 10% inflation on an annualized basis. So I think there's a bit of concern there. But obviously today that we've sort of tried to explain it away is really about used cars, it's about hotel room rates, it's about airline tickets, and it's not really affected the core spending yet, but definitely something that people are talking about and people are watching. And because of that, there's jitteriness both in the bond market as well as in the stock market. I think what happened is that usually if interest rate or bond yields climb, that is bad for bond prices. But if it climbs gently and slowly, equity markets usually can take it. But if it rises very, very sharply, usually what happens is equity market will sell off as well, simply because a very sharp spike in interest rate is bad for equity market. One is, of course, the discount rate that we use to discount equity prices or investments generally goes up, and therefore the value of your future cash flow becomes lower, and therefore you have to take into account that kind of price changes. So that's basically the macro environment and what we see in the market and what we are concerned about. So I'll leave it at that. And Bernice, if there's any questions that our audience would like me to address first.
Yes, I think our audience is very excited. There are actually tons of questions, but I believe, yeah, but I believe you answered when you were sharing your views earlier. You answered some of the questions that our attendees actually sent to us earlier. So some of the questions were their concerns that the stocks are overpriced right now, whether the fear of inflation will result in a bearish market, and also about a downward trend. But generally speaking, from what I hear from you, for the rest of this year, we still think that as a house, that it will be a decent year for us.
Yes, I think we still believe that generally it will be a decent year. Just that we can't expect the very strong performance that we saw last year. The area that we are most concerned about is really government bonds. I think that the concern is that if rates continue to go up, then basically government bond prices would actually come down. And I think today, given that the yield is very low, say a 10-year US government bond is yielding only 1.6 plus percent, there is not enough buffer to offset the capital loss. And I think that's really our main concern. So for our bond portfolio internally, we basically advocate keeping it short, keeping it basically a short duration, meaning stay with the 1 to 2 years or maximum 3 years kind of bonds, rather than going on the long end of the 10-year government bonds.
Okay, so now that we've understood the general macro environment, there are some specifics that people like to find out more about. There was one question that was submitted earlier. What are your thoughts on the US market and Chinese companies listed in US? Do you have any views on that?
Sure. I think that's interesting, right? So far, I think last year, before Biden's presidency, I think there were concerns about US banning Chinese company listing in the US. That has really been a lot more heat, a lot more noise than heat. So basically, if you see, there are still companies, Chinese companies listing in the US. And the idea is that even if they can't, even if something really drastic happens, most of these major Chinese companies have actually now gone to dual listing and listed in Hong Kong. Those companies like Alibaba, so instead of just being NASDAQ listed, now they have a Hong Kong listing as well. So generally, I think we are all right in terms of the, the US listed Chinese internet or tech companies or Chinese companies. I think the concerns today really is not on the US-China issues, but really in that the Chinese government is actually starting to tighten regulation on the Chinese companies, technology companies, especially the internet companies. So I think there's a lot more pressure from the Chinese government in terms of monopolistic behavior or predatory behavior on the internet companies. So Alibaba was slapped with a very hefty fine, and Ant Financial's IPO was really stopped almost at the very last minute. So these are signs that the government is starting to tighten regulations. Basically, they are not allowing the internet companies to skirt around the rules, and not allowing internet companies to basically build themselves into a giant monopoly and becomes the only option for whether for merchants or for consumers. I think that's really the intention of the Chinese government. So you see basically pressure on the Chinese internet companies like Alibaba, Meituan, or Tencent, any company that really looks like a monopoly in the industry are now really target for the Chinese government. So really, that's the one that is exerting more pressure on Chinese tech companies than really the US delisting issue.
Okay, thank you, Damu. So on that front, I've heard that actually increased regulations, be it on these companies or other kinds of regulations, uh, might benefit all these companies in the long run and the general economy. Do you feel so? Is it a temporary pressure, downward pressure that is being felt?
Okay, so I think obviously in the short term it's bad, right? Because if you lose your monopolistic ability or monopoly status, it affects your valuation, meaning that you can no longer behave like a monopoly. You can no longer try to squeeze the most out of your monopoly power. But you're right. It is okay uh, for the ecosystem and for the industry is definitely a good thing, because what you don't want is one big giant company that is really squeezing everyone. And so having options is always good for the industry and good for the consumer especially, right? And you argue that what is good for the consumer ultimately becomes a more healthy industry environment, industry structure than a pure monopoly. And I think that's basically the sort of the long-term view. But in the short term, definitely people are reassessing the pricing power of these giant companies and basically their earnings prospects, especially in the next few years for these companies.
Okay, now moving on to the next more specific question. You have answered this before in some of our previous webinars. I know what you're thinking is either cryptocurrency or like electric vehicles, because we get this question a lot. So with the world, okay, let me read out the question. With the world being optimistic on electric vehicles in the near future, what could be a real growth industry apart from battery, LIDAR, and semiconductor companies. And I think there was another question about lithium companies as well.
Yeah.
Perhaps they could be discussed together.
Sure. Yeah, I think as you rightly point out, a lot of, I mean, sometimes it's not about trying to invest in the gold miners. What you want to do is try to invest in the companies that sells the picks and shovels to the gold miners, right? Because you don't know ultimately which gold miner is going to strike gold, right? So in the electric vehicle space, there's, besides your Tesla, which is the most obvious choice, there's NIO, which is actually been quite popular as well. But think of it, every car maker, every decent car maker would have an electric vehicle roadmap, right? BMW has their I series, Nissan has its Leaf. Every company that has any that has any foresight would have an electric vehicle roadmap. So basically, the winners and losers among electric vehicle makers are actually less obvious, right? So then the argument, oh, let's look into the battery makers, and then there are a few Samsung SDI, Samsung, I can't remember what SDI stands for now, but there are some of these battery makers. But one way to really play it, and we talk about it, is really look at the miners, right? The people who mine the nickel and the lithium, simply because lithium and nickels are going to be used in a battery. And today those are in shortage. I think if you listen to Elon Musk talk about the commodity shortage, these are areas that are in shortage, right? So if these are places that you want to uh, to really play, you can actually play into to benefit from the EV trend, or even companies that does the charging stations, right? So those are the areas. And for the other, there is actually also the need for other commodities besides sort of the most obvious lithium and nickel. It's like copper. Part of the reason why copper have gone up so significantly is also because people realize that with an electric vehicle, you need much more copper, simply because the transmission of the power from the battery to the axle or to the wheels, you require a lot more copper than internal combustion engine or a normal car. So basically, copper is another commodity that might actually benefit from the EV trend. So that's why if you look at the market, what we've seen that has worked in the last few months are whether your BHP, your Rio Tinto, and your Newmont, and all those commodity producers that really could benefit. And this is arguably only the beginning of this whole green trend. So if you're talking about whether renewable energy being a major trend, they are going to need a lot more commodities as well.
Okay, thank you, Damo, for that specific question and your answer. So, okay, next thing, which is something very close to all of us right now, given that most of us are at home. So, just to let everyone know, most of the time, Damo and I are in office somewhere doing this webinar, but today we're at home because our company has instituted the work from home like most people. So, someone asked, what are some of the impacts that come from COVID? Long-term wise, what kind of strategy should you adopt? Should
Okay.
should we even consider this COVID situation as part of our some of the risk, or is it a trend that's going to continue? Do you have any views?
Okay. I think if we look at sort of the COVID situation, there are a few sort of key trends or key themes that we see. One is, of course, from a business point of view, there is now a lot more concern about long supply chain, meaning that if you try to build a product and then you have the raw materials that come from, you ship all the raw materials to China, or you ship the chips from Taiwan, and then you ship all the other parts from different part of the world, ship it to China, and then send it back to the US. That is something that people see as a major risk today because of this COVID thing. Well, is twofold. One is of course the trade tension. The other one is of course COVID as well. So what we expect is that people will gradually sort of diversify, not only diversify their supply chain, but they'll try to shorten their supply chain, right? So a lot of things would be produced closer to home. Uh, there's going to be more localization, and that's probably one major trend that we are seeing. That's but if you think about trying to build stuff in the US, you know that they've not built their manufacturing has been in decline for so long that they might not be able to find workers there. So today, what we expect is that in these countries, we're going to see a lot more investment in robotics. So basically, robotics or automation is going to be a one key trend that we see going forward from this post-COVID world. The second thing is, of course, like as you mentioned, working from office or working from home would at least be part of the future trend, meaning that it will not be, it will be, it probably will be a more hybrid kind of arrangement. That means we are going to see a lot more working from home or remote working that is happening. So definitely in that space, what we see is like trends like, for example, office real estate might be at risk. Uh, so if you basically had been investing in office REITs, you might want to rethink about that. But these are trends that would actually cause winners and losers in something that we want to think about. Healthcare would definitely be one of the major beneficiaries in the sense that the COVID has shown that we had underinvested in healthcare. In a lot of countries, the healthcare system doesn't have sufficient buffer. And if we don't have sufficient buffer, we are not ready or we may not be able to face uh, another pandemic. And another pandemic is almost certain. These pandemics tend to come in cycles. Every few years, we actually would see one. So definitely people are rethinking about how much they need to invest in terms of healthcare. So that's one major area. And I think these are some of the few key themes that we see in terms of the investment trends going forward. I think if anyone is interested, we actually have a series on these mega trends on our website.
Yes, Tabo, you're right. So for the benefit of everyone, do visit our YouTube page, UOB Asset Management YouTube page. We had a webinar earlier this year that spoke about mega trends. So these are some of the topics that and sectors that you would be keen to find out more. I think right now I have to look at the top voted question. So this question was sort of answered in across the last like 20 minutes or so, but the question is, what sector would you want to invest in now? So you spoke about EV, you spoke about healthcare, right? You a little bit, and then I saw some other questions that were asking about technology. So that's another one of them. So is there any out of all these different sectors that you have a preference on, or UOBAM has a preference on?
Okay, I think it really depends on what investment horizon are we talking about, right? So the tech team, the healthcare team are structural stories that we think will play out in the long term, meaning that you can invest for the next 5 years, 10 years. These are going to be growing sectors or growing industry sectors, simply because people will continue to invest in technology, whether it's artificial intelligence, automation. Uh, there is more and more trends in terms of digitization or things like, for example, uh, these people with this COVID, we can't meet face to face. So a lot of sales or a lot of business has to be conducted online and through video. So definitely there is a need to invest in this technology. So these are long-term trends that are going to play out for the in the long run. In the short term, basically, we continue to believe that the sort of the rotation play into the laggards, into things like, for example, airports, airlines, are going to continue. I know that we feel very bad because in Singapore, we just instituted another lockdown without calling it a lockdown. And in, we see that in quite a number of Asian countries as well. So you see it in Malaysia, you see it in Thailand, you see it in Taiwan. There's rising cases of COVID, rising COVID cases, and therefore we are more fearful and we are probably more cautious. I think India is another country. But if you look at sort of the global numbers, Europe is actually starting to unlock. UK being the first to unlock, and then basically continental Europe is probably starting simply because as vaccine starts rolling out vaccine starts rolling out, uh, governments would have to unlock the country to let let the economy get back to life or get back to work. In US is probably one of the major countries that has the fastest vaccine rollout. And what we are seeing is that if you look at the economic data of US, it's actually gone up very, very strongly. So basically, we expect that in the rest of the world after US as well. So if you are looking at sort of the short-term investment story, it's really about the economy going back to normal or the economy getting back to work. And these are the laggards that really that you want to be you want to have a position in. We mentioned before, whether it's the airline companies or some of the hotel companies, more of the global hotel companies that benefit from the reopening as sort of life gets back to normal. I think these are some of the areas. But of course, there's nuances. Do your homework, right? So in hotel, for example, we believe business hotels might struggle a bit more because people really don't want to fly around for business anymore, especially those days in which that people fly to a country and just spend one night there for one meeting. Those days are probably gone. Those days are probably over. But think of it, if life gets back to normal, do you still want to go for a holiday? Do you still want to go out and have a good meal? The answer is probably yes. You want all those, right? And so those, like, for a hotel point of view, leisure travel might actually be the one that survives, but whereas business travel might actually struggle for a bit longer. So there are nuances. You need to do your homework.
Okay, thank you, Damo. So just to answer a couple of other questions that are more related to the app, I think you can take a breather for now
Okay.
while while I approach some of the questions. Okay, I think there were some people who wrote to us asking specific questions about their own account. We will get back to you as soon as possible by reaching out via your email address. Then on some of the other questions, whether we have joint accounts available, unfortunately at this point, we do not have it available for UOBAM Invest mobile app yet. But this is something in our plans. Hopefully we'll be able to announce the launch of these kind of new features, as well as for US dollars as well. So currently we do not have this option available. Investments are all in Sing dollars, but we actually have this all in our plans, and we will come and speak. We will actually update everyone as soon as possible. There are also some other questions about our robo performance methodology. Should you still continue investing with us? The answer from me is yes. Damo will elaborate. He will have the difficult job to elaborate. But I think there are some other big themes that I see in the Q&A that I thought we should really try to approach. For the audience, if you can help us out by upvoting the questions that you are more interested to have answered, because we have 33 questions right now that are not answered yet. Do help us to upvote the questions again. Okay, gentle reminder, post your questions in the Q&A box. Okay, follow the icon. So our favorite, maybe, yeah, crypto. Given that, I mean, we were just discussing, right? Bitcoin fell below 40,000, and what's happening? Yeah,
Right.
what triggered this and all that. So I guess people are curious as to
Okay.
maybe how it might even affect our traditional investments too. Will it,
Okay.
in your opinion, affect
Okay.
this kind of our traditional investments?
Okay. So we've always struggled with crypto in a sense that especially when it shot through the roof and everyone still kept asking us why aren't we into crypto, and we always answer that we are not smart enough to understand it, and it is so volatile that we are really concerned. I mean, this bout of volatility, if you remember, uh, Elon Musk says that, oh, we've invested in crypto and we're going to allow Bitcoin people to use Bitcoin to buy the Tesla cars, and it went up significantly. And then the moment he says that, oh, we're now a bit concerned about Bitcoin because of the environmental impact, and we may not allow Bitcoin to be used to buy our cars, and it collapsed. Uh, it for something that can be uh, I don't know if manipulated is the right word, but for something that can swing around so fast just by one person's comment, to to us is not really a good uh, subject for investment, right? It's not a good asset class to invest in. I think that's basically our concern. And therefore, we think that it's not something that we want to venture into. Uh, and we basically always advise our clients to be cautious because you see, the thing is, you invest in whether if you invest in gold, something goes wrong, well, you go to a goldsmith and make it into a gold chain that you can wear, right? If you invest in wine, something goes wrong, you can drink it. That's if you invest in art, if it doesn't work out, it still looks very nice on your wall. If you invest in Bitcoin, something goes wrong, I don't know what you're left with, and I think that's basically sort of the concern that we have with Bitcoin as well. Do we think that it will spill over into the real investment? I think at this moment it is probably too small as an asset class to really have that ripple effect into the rest of the investment world. And if anything, if people leave Bitcoin, I think money might actually flow into other investment asset classes, and I think that might really benefit the other asset classes.
Okay, thanks for your views on crypto, which I've heard many times before, because at every webinar somebody asks us about crypto, right? Now, okay, next interesting question about, okay, the question is, what are your views on some of the higher beta growth stocks? Names like Tesla, Snow, Pins
Mm.
have fallen from highs in February, but are significant higher than early last year. Is this an opportunity to go in, or is it catching a falling sword? So
Okay.
growth stocks.
The short answer is I don't know. Right. The long answer is that what I mean, do your homework in a sense that personally I don't analyze all these stocks one by one, but the general rule of thumb is do your homework and basically look at it and says what's the prospects of this company in the long run and whether it justifies their market cap or their market value. At one stage, for example, Tesla was trading at a higher market value than all the car companies in the world combined. And obviously, there's something wrong with those sort of maths, right? How can a Tesla has that produces less than 1% of the world's car be worth more than all the world's car companies combined? I think that's really the question that you should be asking, especially when Tesla again doesn't really make money from making cars. They actually made more money selling carbon credits than anything. So if you think of it that way, then basically you can question uh, whether that market value is correct in the first place. So what is the real fair value of Tesla, I think, as I said, the short answer is I don't know. But basically, you have to think of it from a prospect point of view. What is Tesla's prospects in terms of growth? Would it grow as fast, and would it grow bigger in terms of its business than it is today? Can it grow significantly bigger? Or do you think that there are now enough competition from other EV makers that the growth prospects would really be slowing down from here? I think those are questions that you need to ask. It's the same for a lot of internet companies. There were a lot of uh, exuberance on these companies earlier in the year, uh, and some of them may actually be maybe overinflated as a result. Today, whether it is a bargain after a 20-30% correction, I think it's something that you need to analyze in terms of the future prospects on whether it can justify its market value today.
Okay, so something related to that. So we talk about growth stocks, right?
Mm-hmm.
So let's bring this broader. What's your view on growth versus value?
Okay,
Which one is more suitable at this point of the cycle?
okay. Uh, Good question. I think growth stock has actually outperformed value stock for almost 10 years now, right? Value has outperformed growth over the last 3 months. And I think that's basically the situation that we are seeing. Uh, and I think if you look at the sort of short term, uh, I think value can continue to outperform growth simply because, as I mentioned, the rotation, the reopening trade uh, tends to favor the sort of the value stocks that that benefit from reopening of the economy. But I think in the long run, we still favor growth as a style or as an investment style because we think that uh, companies basically need to grow in order to really accrue value to shareholders. Value as a style, basically, you really need to go and invest, look for things that are cheap relative to its fair value, and after a while, if you are right, that value stock gets re-rated and repriced, and that's it. That's the end of the game. But growth is really a style in which that the company can continue. If a company can continue to grow, it continue to create value for shareholders. So I think from our point of view, we always find that growth is an easier idea to buy, to invest in, simply because once you find a right company that's growing, management that has this growth mindset, you only need to invest once and the managers are doing it for you, right? The rest of the work for you. Whereas finding value, you basically need to find something that's cheap, and then market needs to convince that it's mispriced, and then basically the pricing gets the mispricing gets corrected, and after that you need to go and find another mispriced investment. I think that's really tougher, and so we think that in the long run we still favor growth as a style.
Okay, that's good. And for all our investors out there, we actually do adopt a diversified point of view. So it's not all just growth, right, Damo? Although we
Yes.
favor that a combination usually works well, especially when we have professional managers who are helping us to manage the portfolios. So next question is more of an investment strategy. Should you sell stocks at a loss or wait until the stock recovers, if it ever recovers?
So basically, I think the question is this. Today, if you don't own the stock, would you buy the stock at that price? I think that's basically the question, right? Just imagine, ignore the fact that you own the stocks that has lost money. But today, if you don't own that stock, would you be buying that stock? Does it look attractive for you? And if the answer is no, then then my advice is then you're better off selling that stock, right? If you don't really want to buy at that point in time, you might as well sell it. it might be painful to crystallize that loss, but if that stock doesn't recover, you're basically tying down your capital. I mean, in our term, we call it dead money. You're tying down your capital without really making any returns. You're better off trying to find an alternative that can give you a better return, right? So that's basically the principle that we tend to adopt. Start by thinking that if you don't own it, would you have bought it at that price? If the answer is yes, it says that look, at this price, I think it's cheap, and I think the prospects of return is fairly high. Then the answer obviously is yes. Then you should hold on to those shares, to those stocks, and wait for it to rebound. I mean, if you can, and if you're right, if you can, you actually might want to average your dollar average your position, right? So that's basically the principle. Usually, holding on simply because you've already lost money is not a good strategy, and is not a good habit.
Okay, and let's bring up another question on strategy. How often would you rebalance or tweak your portfolios?
Okay, so it if you're talking about your individual investment, the thing is, if you really have strong conviction uh, in a stock, you should hold on to it as long as you can. Okay, from an investment portfolio of stocks point of view, uh, what you should do is that if one stock has become too big a position in your portfolio, you should obviously trim it, right? Because you still want to maintain that diversification. So if one stock has become 20, 30% of your portfolio of 30 stocks, for example, then basically it's really gotten too big for to be well diversified. So that's generally how I look at rebalancing. Really, it's about maintaining that balance in your portfolio. In asset classes, usually it is good to look at it every 3 to 6 months and say, look, it has moved away from what I expect in terms of the asset classes that I want to be exposed to. And then you may actually then rebalance, meaning that for those asset class that has performed well and has grown bigger than what your original plan is, you may sell some and reinvest it in the asset class that has not grown as fast, or that has sort of lost money, and you basically try to buy at a lower price to dollar average. So basically, it is a function of trying to find that balance to rebalance your portfolio back to where you want it to be. And for those of asset class rebalancing, we usually advocate something once every quarter, or once every 6 months.
That's good. So, our UOBAM Invest app robo-advisory service actually mimics what the behavior of what Damo suggested. We actually have a rebalancing that happens at the end of every quarter. So that is what was decided that would be optimal. But of course, if you would like to trigger additional rebalancing through your portfolio, you can always perform a deposit, a withdrawal. So that's entirely up to you. I think we don't have a lot of time, but just one more question I think we would like answered. As all of us are in Singapore, we are in Asia. Can you share any views on Asia high yield, Asian equities?
Okay. Uh, I think in the short run, we think that Asia might actually be a bit more challenged for in terms of Asian equities. The reason is this: I think Asia today, there's a big part of it, of course, is China. And if you look at sort of the Chinese environment, what we are seeing is the Chinese government is actually one of the few central banks that is not easing monetary policy. If anything, they're gradually tightening the monetary uh, situation, because they are the first to get into COVID and the first to get out of COVID since about late last year. And with that, the excess liquidity in the system, or the monetary policy is now actually starting to be tightened. I think what they don't want is too loose a monetary policy that encourages companies to take on too much debt or encourages consumers to take on too much debt. I think we are seeing that sort of things happening, that the government is trying to control credit or can control credit expansion. And because of that, we think the short-term market environment is actually going to be a bit more challenging. I mean, what we've seen with that is really also a matter of Chinese companies or some Chinese companies defaulting on their bonds, and the Chinese government is actually allowing them to do so, right? So it's that basically shows a situation that is probably more challenging for Chinese equities and maybe Asian equities as a whole. And of course, the second thing that I mentioned just now, we are from a sort of vaccination point of view or from a COVID situation point of view, Asia is actually a little bit more challenged than say the rest of the developed world. So I think that is probably another drag on the sort of Asian performances. So this two we think generally are going to weigh down on Asia investments. There are obviously some sectors that benefit. I think we are some North Asian countries are big on technology, and the trend, as I mentioned, is that if we're going to continue on that tech trend, that structural tech trend, uh, there might actually be some of these companies or some of these industries may benefit. But I think if we talk about very broad terms, Asia might actually be more challenged in the short term. In the long run, obviously, Asia still has better growth than a lot of the developed world. So on a long-term trend basis, Asia is still attractive. But in the short term, we think we rather be more cautious and more conservative on Asia.
Okay, so how are these views? And I think there were some questions about our methodology, because our robo actually implements institutional mandates that we as a company that has been around for more than 30 years, managing institutional monies. The question is really, I think, a combination of from a few questions. What exactly is our methodology? How do we reflect our views in our algorithm?
Okay. So there are a few things. One is, of course, we diversify the portfolio across asset classes, across geography. That's sort of the basic principle. So we are not exposing you to a single asset class or a single region. If you have been with us, you would know you have probably made decent money, especially if you are the more aggressive side. You probably make fairly decent money from the robo-adviser. And it's really, if anything, it's the sort of the more conservative portfolio that is more exposed to government, to bonds that really struggle a bit, as I mentioned just now earlier. Right, so that's the first principle. We diversify the portfolio for you. Two, we tailor the portfolio according to your risk appetite. If you are more risk averse, then basically we give you a more conservative portfolio. If you are more aggressive, we give you a more aggressive portfolio. And that's basically the basic principle. For a specific risk profile that we have on you, we tailor a portfolio that is appropriate for you. That's the most appropriate for you. That's the second principle. The third principle is that we look at each asset class carefully, meaning that we not only take into account we when we try to deliver the solution, we look at the expected return and the risk of each asset class very carefully, and we actually constantly review that. One example I can give you is, like, for example, late last year, we actually shifted a lot of investors out of the growth stock or the US growth stock. I think you remember last year, US growth stocks were all the rage and all this. But by late last year, the robo actually says, from the input from the investment team, in terms of the expected return, the robo actually says, hey, the risk return profile of growth stock is not favorable, because after such a strong rally, growth stocks is really expensive compared to its own history. And with that, we actually shifted clients out of US growth stock into into a few areas. One, either into broad global stocks, or two, Asia ex-Japan stocks, depending on your risk profile. And that actually really works out, because that really avoided the sharp drawdowns in the growth stock earlier this year. And that's how we think we express our view, our investment view, and we sort of add value to your investment portfolio, simply because we look at each asset class that the robo has access to, and says what is the expected return and what is the expected volatility of each asset class going forward. And from there, the robo would actually sort of customize or optimize a appropriate portfolio for investors.
Okay, and I think we have, just to let everyone know, we will be doing an adjustment of the capital market assumptions. So very soon, likely sometime next week. So Damo, would you have some information to share about the changes that we'll be making?
Gosh, I can't remember. I know that we were doing this previously. Sorry, a couple of weeks ago.
Yeah. No worries, no worries. Because we'll be sending out an email to update everybody as well. Okay. About the changes that are coming, that are actually written by you. So, so I think everybody can just look forward to your email coming up. Okay, no worries. Anyway, we're also running out of time. I think for today, okay, as much as possible, we've tried to answer most questions, and unfortunately, some of your questions we've only been able to answer it partially. But I hope it has been a very valuable session for you. And if you want to look forward to hearing more from Damo, some of you want to ask more specific questions about different industries and all that. We do have another webinar coming up, actually several webinars coming up in the next couple of months that will cover topics like our market outlook again. But this is luckily an even more casual session where you get to like see Damo's face with how stressed he is when he's answering all the questions. But we'll have other sessions coming up on the market, as well as on retirement planning, as well as to provide more information on our robo. So if you're keen, do sign up with us, and we will continue to send out exclusive invites to all these webinars. For those of the rest of you who have other burning questions, you can also email us. The email address should be available in the chat. If not, can my colleagues help to submit? UOBAM Invest at uobgroup.com. You can actually email us and we'll write back to you regarding your account or regarding any other questions you have. Okay, thank you so much, Damo. It's time for me to flash our QR code again.
Thanks, Bernice.
Thanks for your time. Thank you. Okay, so for those who have enjoyed this session as well as our other webinars so far, and hopefully if you're a new customer and just getting to know us, you'll be able to actually join us and sign up on our UOBAM Invest app. The QR code is available there. For all customers from this period until the end of June, there's actually a $10 promotion, which will be credited to your account. But exclusively for attendees of our webinar today, you'll receive an additional $20 NTUC voucher. Very useful in this during this period. This is quite rare, so do make use of this opportunity. We'll be tracking the attendance and the sign-ups through your mobile number mostly. So if you have any other questions, please feel free to let us know. Investments only start with, you only need to start with $1. So feel free to let us know if you have any other questions, feedback. The feedback link should also be available in our chat box. And thank you very much for joining us here today. We're almost out of time, and hopefully we'll see all of you at our other sessions. Thank you so much and have a good day. Okay, since we have another 2 minutes, let me try to answer some of the questions pertaining to our app. When I see, let me look through the questions. Okay, about the difference, we get this question quite a lot as well. How is UOBAM's robo-advisor different from other of our competitors? So mainly, firstly, I think I shared earlier that UOBAM is an asset management company. We have been managing institutional monies for more than 30 years, and we have a very long track record. In terms of our stability compared to other startups, and as well as other newer companies out there that you see, we are actually backed by UOB Group. So in terms of security of your accounts, in terms of our duties of protecting your data, etc., this will be upheld at a very high standard, given that our parent company is actually, we are wholly owned by UOB Group. Other than that, of course, in terms of our algorithm and the portfolios that we recommend, they are actually customized portfolios that are recommended to each and every one of you. That is determined by not only your risk profile. So some of the other robos out there, your portfolios, you'll receive what we call standard portfolios for each risk level. For us, it's different. Your portfolios are recommended based on your time horizon as well as your risk level. So, and the goals that you set within our app. So the portfolios for everyone will be slightly different depending on how long you choose to invest in. Other than that, we also have what we call a glide path solution, where we will, on your behalf, take note of the reduction in risk that you need to have should you require earlier liquidity. Meaning, a customer who is under an aggressive portfolio, for instance, would have lower exposure to equities if their time horizon is a much shorter time horizon compared to somebody who can invest for a longer period of time. Because as we all know, volatility and risk exposure actually reduces over the long-term period. Okay, so other than that, of course, our performance numbers for retail has not been available, is not available yet, but will be available very soon as we hit our 1-year anniversary. Our corporate solution, which I think a lot of people are not aware of, but should know about, has been around since end of 2018, and we have received very good traction. Many of the companies in Singapore and even overseas have been investing with us. So if you have some time, do check out our website, join us so that you will at least start to receive information from us, articles from us, and also exclusive invites for our webinar. Thank you so much, and I hope all of you do sign up for our app. Thank you.